Hello, hi. Hey, it's Julie Zemelis, Marla Wynn, Scott Wynn from the Wynn and Eagan Team, and we are coming to you live with a mortgage market update. And we are doing this monthly to give you guys opportunities to learn more about what's happening in the rate department, but also give you a chance to ask questions. So as we're discussing the first couple of topics that we're going to discuss, put your questions in the comments, and our wonderful moderator, Eric Zemelis, will help make sure that those questions get out to us, and we'll get those answered. So let's get going here. So let's start with rates. So Wynn and Eagan Team, let's talk about what's happening. Are they going up, going down? What's the story? Who wants to take that question?
I can take that.
Okay.
So, what we've seen is that, rates hit historic lows, and we've been at really, really, really low rates for quite some time. And I think it's kind of given us a false idea of what the interest rate market really looks like historically. But if we look over, let's say, just the last 2 years, we hit a low in about December. Mm-hmm. And from there, we did a slight bump up in January, and then a big spike up in February, and then March, and now here, we're kind of leveling out, and if not, just kind of coming down a little bit.
Okay.
If you look at what the economists suggest where we're headed and where we're going to end up the year, so we're talking about like the National Association of Realtors and the Mortgage Bankers Association, they are forecasting that the average interest rate by the end of the year is going to be right around 3.18%.
Okay.
Well,
Which is still pretty good.
Oh,
that's
fantastic.
awesome.
Yeah.
If you look historically, it's just amazing, right? I don't even know what the average interest rate is historically, but it's certainly nowhere in the 3s or even the 4s, right? Mm-hmm. And so to have an interest rate at 3.18% by the end of the year is still fantastic. And even right now, we're sitting at about 3.13% for 30-year fixed mortgages. Now, obviously, there's lots of factors that play into that. That's based on a conventional loan, owner-occupied, 20% down, 720 plus credit score, things like that. But that just gives you a general idea of where rates are and what's happened here recently in the last few months.
Very cool. Marla, you have anything to say about that?
Just that so many times in the last 10 years, I thought we were at the low,
Oh.
and then
you better buy
they
a
went
house
lower.
now. They're not going to get any lower.
Yeah.
So,
Still,
and with the rates and stuff, with the economy kind of like all of a sudden it looks like things are kind of like starting to kind of like turn around and chug back up. You're not seeing them deciding to raise the interest rates to slow down some of the crazy housing pricing. That's not happening as far as you're concerned, right?
When you say they increasing the rates, what I
Feds.
assume you mean is the Fed
Yeah.
increasing the rate. And what's interesting is that the Fed rate is not tied to mortgage rates, directly anyway. They're both tied to the same things, but the Fed rate does not impact mortgage rates. So the Fed rate is based off of all the economics of the United States, right? So consumer price index and consumer spending and the housing and all of those sorts of things. Well, same thing with mortgage rates, because the mortgage rates are really tied to the Treasury bonds. Mm-hmm. And Treasury bonds are tied to all of the same things that the Fed rate is tied to. So when the Fed increases interest rates, that's not saying that mortgage rates are going to go up. What that generally means is that short-term interest rates are going up. Those are going to be things like auto loans, student loans, credit cards, and things like that. But the reason why we typically see mortgage rates follow Fed increases is not because the Fed increased it, but rather because they're tied to the same economic reasons as to why mortgage rates go up. So even if in the future the Fed increases interest rates, I'm not necessarily suggesting that mortgage rates are going to follow immediately. Generally, there's going to be a little bit of a lag just because that's how they work. Mm-hmm. So we'll have to see what happens as the economy gets better and better. But if you look at the stock market, which is what's impacting the bond market, which impacts the mortgage rates, it's all tied together, right?
And then the stock market hit another all-time high today.
Exactly.
Yeah.
And so the economy's already doing really, really well from that perspective. The stock market's doing very, very well, which is keeping bonds low, which is what keeps mortgage rates low.
Right.
So we'll just kind of have to see if there's a big tank in the stock market, then we might see something different. But who knows, right?
Right now, we're chugging along like a good cruise ship.
Yeah.
Okay, so Lori says, aloha, everyone.
Lori Bond.
Aloha.
Yes.
Hello, Lori. Nope.
Lori Porter.
Oh, Lori Porter. Good.
And then we've got Brian says, aloha.
Hi.
That's and then we've got Jenna says, aloha for Alaska. And Brian says, this may be in the weeds, but Julie, you posted something from market trend, good information, and they were thinking about rates could be lower, speculated to drop down one and a fifth. Thoughts? One drop down.
Right.
Thoughts?
Yeah.
That-
Well, and
that
again,
makes sense.
you know, it's so funny because I don't know if you guys. So I put this mortgage market update that one of my clients is doing, and he was talking about, and again. I don't quite understand the bond market completely, but they were talking about how mortgage rates, like you said, affect everything. And they're saying that maybe it could even drop even lower. And so they're going off of all the information out in the real world, too. So is that the question? Does he say that is Scott going to...
Speculated to drop down.
Okay, so just what do you think, Scott? I mean, you probably watch the same kind of stuff that everybody else is watching.
The thing is we can all be right 50% of the time, right? It's like we can be a weatherman here in Hawaii. It's going to be sunny and 75. I mean, right? I mean, I don't know exactly how to respond to rate expectations or forecasts because we even subscribe to economic forecasts for the purpose of short-term interest rate volatility so that we can help our clients in locking on the right day. If we know that there is something that's projected to come out that's going to impact mortgage interest rates within the next day or two, then we might hold off for a day or two to lock in an interest rate so that we can help secure our customer a slightly lower rate than what they would if they were to lock in today. As far as anticipating what's going to happen a week from now or a month from now or a quarter from now, like, it's impossible. And in fact, I tracked it for a while with the economic data that we got from that service that we subscribe to, and they were right about 50% of the time.
Okay.
So,
It's like
I mean,
a weather report.
The best forecast of interest rates would be to get a quarter out, flip the coin, and whatever it says, heads, rates are going up, tails, rates are going down.
But for the most part, though, know it's not going to go above 4%.
I don't think it's going to go up 4%, no. I think we're probably going to be fairly flat for the foreseeable future. I don't see that we're going to see any big spikes like we did a couple of months ago when it jumped up quite a bit. But again, I don't know.
I think one of the challenges if rates do increase is the affordability of homes, because homes are increasing, the value of homes are increasing, which makes them less affordable, and if they increase interest rates too, then that makes it even less affordable. So I wouldn't hold out and wait for a rate drop. If you're interested in buying, I would buy now because the value is increasing it enough that it's going to offset any savings in rate even if the rates do come down.
Right, and that's basically kind of what these guys were saying, that now is the most important time to buy a house because it's never been more affordable because interest rates are so low. And so even if you have to pay a little extra for your house, it's okay because the interest rates are so low. So that was kind of like the gist. And also, like you said, you never know what's going to happen with the future. I was looking back on the mortgage forecast or the housing market forecast that came out in 2019, and they said we were going to be in a full recession by 2020. Full recession, and then all of a sudden, boom, something happens they can't even see it coming, and then all of a sudden we're selling houses like pancakes, right? And so it's just, you never know. But one of the things that we do want to talk about is when this is happening with the housing market is with the price of housing going up so quickly that trying to get the appraisals is a big issue. And so what happens when an appraisal comes in too low for the house price that you're trying to get?
Yeah, I think Scott's dying to answer this one.
Go.
So one of the things that I always find interesting is how that phrase is worded, right? Appraisals are always coming in low. Well, it's not necessarily that the appraisals are coming in low. What's happening is the appraised value is coming in lower than the price of the home, right? And so a lot of people like to turn to the appraiser gave me a low value. Well, that's not necessarily the case because appraised values and the price of the home are two very different calculations. When a real estate agent generally is listing the home, they're doing a similar kind of analysis of what the market's doing as what an appraiser does, but they do it based off of what they think the market will bear, meaning what will a buyer pay for the house, right? That's how they list the home.
Right, and that's based on also on demand that's
Absolutely.
happening right now, right?
And demand is huge right now, so of course homes can be listed at maybe a little bit higher than what the value is according to the appraiser. So what does the appraiser do? Well, the appraiser is required to, by the lender, that's why an appraisal exists, is to determine what the value is of the home. Because the value of the home and the home itself is the collateral for the mortgage. So if there's a default, then the bank gets the home so that they can sell it and recoup their loss, right? That's what an appraisal and loan is for. So when an appraisal is done, rather than determining demand and what a buyer might be willing to pay for it, what an appraiser's responsibility is to look at recent sales for similar properties that have sold recently. And so they have to do comparable sales. And so when an appraisal is done, they will generally find the 3 best comparable sales, sometimes 4, 5, 6 comparable sales that have sold in the most recent time period, very, very similar to that particular home. So it's not that the appraisal is coming in low. It just means that the appraisal came in at the value, and
It's not what the realtor placed it at.
exactly.
Right.
And it might be lower than the purchase price, but doesn't necessarily mean that the appraisal is low.
Right.
If that makes sense.
Okay. So
Just-
what happens is that people are bidding up the housing, right?
Absolutely.
And so then all of a sudden now a house that was listed, let's say 750, now comes in at 800.
So, but all those factors increase the comparables so that then appraised values will come up. So all the cash sales that are happening above list price, and all of the financed homes where people are paying for an appraisal gap,
Yeah.
all those comparables now are going to be something that appraisers can use to increase or justify value on other properties. So really, if those things weren't happening, it'd be very difficult for the values to come up. You know, like we have to have those things happening so appraisers have.
So every
comparables.
house that goes for, let's say, $50,000 or $60,000 over what it got started at now lifts the value of all the houses in that neighborhood.
Absolutely.
Now, what happens though when you can't get a comp because the housing in that neighborhood isn't selling because there's no inventory on the market?
Well, that's a good question. I think appraisers go outside the neighborhood.
And start to kind of just do that?
Yeah.
That's
Okay.
how they do. So they'll start as close in proximity to the subject property as possible to see if they have recent sales. If there's no recent sales, then they'll expand it a little bit more. And then if there's no recent sales, then they might expand out the time horizon. So rather than a most recent sale within the last 3 months, maybe they'll go out to the last 6 months to see if there's properties. If they're still not, then they can continue to expand their criteria until they find comparables that they can utilize for the appraised value.
Yeah.
Okay.
So, and agents that list can provide their appraisers when they come in with all the comps that they used that can help that appraiser, you know, get to the value if the listing agent feels like they priced it right.
Okay.
Because that information is really good for an appraiser on the front end to provide, because it's like a friendly exchange. Here's this information, but it's difficult to come back to an appraiser after the fact and say, well, why didn't you use these comps, or this is what I used, because then they're defensive.
Yeah, because then they think you're trying to get them to change the price.
Right.
Okay.
And you don't think I know how to do my job, so now you're telling me that this is, you know,
And
why didn't you use these?
Well, and also, and again, I was in the Bay Area before the appraisal, just because the housing market run up in 2005, 2006 was so crazy that some agents were actually picking the appraisers that they have known for 25 years.
See, and that's illegal now.
That's a
Yes,
big thing
and
that
coming
changed.
in and saying, "Hey, Bob, I need you to get this thing going to 650,000," and then Bob would say, "Sure, as long as you keep using me, Doug." So
Right.
then all of a sudden things started going crazy. So this way, now that's a thing of the past. You can't do that anymore, right?
Yeah, and it's
so-
protecting the integrity of the housing market.
right the consumer,
Right.
right.
In fact, we have to go through what's called an appraisal management company. So it gives an arm's length distance between the lender and the appraiser. So we have to go through an independent company that then randomly selects an appraiser from their pool.
Right. So that's happening here in Hawaii.
Yeah, happens
Okay, 'cause
everywhere.
they started doing that in
Every
California.
mortgage loan that's done FHA, VA, USDA, or conventional financing has to follow that same protocol.
Okay, good.
Yeah, it's just, we can talk to the appraiser after the appraisal is done, but we still communicate with them typically through the AMC. Like, we'll send information through the appraisal management company, and then they get it to the appraiser, but we're not allowed at all to talk to them ahead of time.
Okay.
But let's go back to the original question, right? So what happens if an appraisal comes in low, right?
Right.
Where the appraisal comes in lower than the purchase price.
Right, because now all of a sudden the buyer's on the hook for covering the delta between
Right.
the purchase price
And that's
and
what
the
we
mortgage.
refer to as the mortgage, or the appraisal gap.
Okay, appraisal
right?
gap.
Is
Okay.
that the difference between what the appraisal came in at value versus what they're purchasing the price for. So when that happens, there's a couple of different potential resolutions.
Okay.
One is that the seller agrees to reduce their price down to what the value of the home is.
Has
Now,
that ever
that's not
happened?
Not in
happening
today's
right
market, not today.
It doesn't happen in today's market. It does happen.
It does happen, yeah.
We've seen it in a more traditional market or a buyer market. Then in that particular situation, that happens almost all the time. In a seller's market like we're experiencing now, that's not going to happen, right? So without that happening, then the other option would be to possibly split the difference, right? Where the seller comes down a little bit, the buyer's willing to pay a little bit more than what the home is worth according to the appraiser. So that's another possibility. Or they leave the price as is, and then the buyer just has to come up with the cash difference between what the value is and what the house is being sold for. So really that's what happens when there's a difference between the appraised value and the price of the home.
No, get this though. So, you have to say, "I'm throwing this much money at your house. You win! Yay! then you're in escrow, and then all this starts to show up.
Yes.
How soon, as soon as you get into escrow, does this show up?
As soon as the appraisal is done. So
How soon is that?
So it depends. Go ahead.
Turn times right now for appraisals here in Hawaii are 2 to 3 weeks.
Okay.
And we don't order the appraisal typically until after they're through J1. So once they've done the inspection and everybody feels good, then we order it. So it can take a little bit of time.
Okay. Because now, let's say someone can't make the delta, then the seller has to put the house back on the market, right?
Yep.
Are you guys seeing that, or?
I haven't seen that. In this market, what I've seen is buyers coming up with a difference.
Okay, so
And
they know if they got that far, they should do the best work they can to figure out where they're going to make that money happen.
And there's different ways they can come up with the money, right? I mean, so just an example. Let's just say somebody's putting 20% down on their home purchase, right? And now all of a sudden the appraisal comes in lower than the purchase price, and they have to come up with that gap, and they don't have the funds. Well, now instead of a 20% down payment, maybe they do a 10% down payment, and so now it's freed up that extra 10% that they were putting down to use for the gap. So that's one way they can cover the gap, right? They could get gift funds from, let's say, a relative or something like that to help cover the gap. So there's a couple different ways.
Some 401ks offer or allow for
borrow against your
Yep.
401k. Oh, that's a good idea too.
Yeah.
And also then theoretically you could also, sell some investment property back on the mainland or, ransom off your children. So in that,
I don't know how an underwriter is gonna. How are you gonna document that? I've ransomed.
I ransom off my firstborn. I'll be working for this house. But that's another reason why it's important to use a really good mortgage lender too, to be able to strategize that experience, because you guys know how to do these kinds of little, like 10%, 5%, pull this over here kind of thing. Because that really, you have to really know how to work this market to be able to do that, right?
Right.
Yeah.
And you can get creative with it, like you're talking about, right? I mean, a lot of people listening to this might say, well, I don't want to reduce my down payment less than 20% because now all of a sudden I'm going to have to pay mortgage insurance, right?
Right.
And yes, you're going to have mortgage insurance, but there's some different ways to play with mortgage insurance. You can do monthly mortgage insurance, or you can do what's called lender-paid mortgage insurance. So with a slight bump to your interest rate, you can actually completely cover mortgage insurance, so you don't have to pay it on a monthly basis in terms of monthly mortgage insurance. Instead, it's just rolled into the interest rate, and it's not nearly the increase in monthly payment based on the interest rate increase as it would be with the monthly mortgage insurance. So there's some ways you can play with that. Now, whether that makes sense really depends on how long you anticipate owning the home and how much of the rate increase it has, and those are all the calculations we do for our clients to run those calculations to see, does it make sense to go one direction or another, or to go from 20% to 15% to 10% or whatever it might be. So we can...
And then you kind of just check the length of the loan to see what it's going to be at the back end. And so that way at least you can make a pretty good decision based on the 3 or 4 different scenarios that you present, right?
Right.
Okay.
It is kind of amazing though where people find money when it.
Yeah,
when they need to.
I'm moving to Hawaii. Let's get a GoFundMe going. So, Eric, is there any questions? This is where you guys could throw in your.
So we've got Lance says aloha from the Bond family, and Lance also says good information.
Good.
And those are the comments so far.
Okay.
So this is where we're opening up to questions and answers about any type of market question about financing, mortgages, anything you guys
So
have
one
questions
thing
about?
I'll mention while we're waiting on some comments to
Okay.
potentially come in is that whole topic of reducing down payment, because this is the market where you have to get creative to make things work, right? And this is where expertise really comes into play. And one of the things that I have learned over being in this industry and looking at all these different situations is that what's interesting in the mortgage market is that a 20% down loan is actually a higher risk loan in comparison to a 15% down payment loan.
Why?
And it's because of how mortgage insurance works, right? So on a 15% down loan, you have to have mortgage insurance that covers 12%. So what that means is you're putting 15% down, and then the mortgage insurance covers the next 12% in the case of a default. So you're at 85, so what's that put you at?
37.
73.
Oh, yeah.
So you're at a 73% risk, according to the lender, on a 15% down loan. Well, if you go to a 20% down loan, there's no mortgage insurance to protect the lender at all. So now they're up at the risk of level
100%.
80%.
They're at an
80%,
80% risk versus a 73% risk. So what does risk basically correlate to in mortgages?
Money.
Interest rates.
Yeah.
Money.
Yeah.
So
Yeah.
the higher the risk, the more money the lender wants to take on that risk. So generally what you will see, and it's minor, but it's enough that it can make a difference in some cases, is that with a 20% down, you might actually have a slightly higher interest rate than you would with a 15% down loan.
No.
And so that's where you can play with that lender-paid mortgage insurance to basically get the same rate as you would with a 20% down, but get enough of a rebate to be able to pay for the mortgage insurance and put less money down. So there's some different ways you can kind of play with that sort of thing.
I've never heard of that.
But it's kind of a unique way to structure things.
Yes. Question.
A couple of things. We've got Brian says 401 and IRA rollovers is what his question is.
So I think he's referring to coming up with additional cash for down, right?
Yeah. So if you have a 401k plan, some of those 401ks do allow for loans to be taken for specific things, and buying a house is one of those.
Is there like a penalty for doing that?
They don't penalize you for doing that.
So if you specifically say you're using it to buy a house?
Yeah, I mean, you have to provide them with documentation in order to get the money out. But yeah, they don't charge you any penalties to do that. And then you can you repay the loan on a monthly basis after that. So we just have to work that payment into the DTI.
Each 401k provider is a little bit different. Sometimes there's an interest rate on the loan that you're borrowing, but the interest rate is on your own money, so you're basically paying yourself back interest. So there are some potential changes depending upon who you use. Yeah. And then also, IRAs can sometimes allow you to withdraw money. I don't know if there's penalties or not. That would be something worth looking into, but I believe that there's a clause for purchasing like a first home. Not necessarily subsequent homes, where you can draw money out without penalty. You still have to pay taxes on it in that particular situation, but I think there may be some exceptions there, so that could be worth looking into if you're looking at purchasing a first home. And then on a Roth IRA, because you contributed after-tax dollars to the Roth IRA, you can generally withdraw that money without taxes or penalties if you need access to the money. But again, we're not tax advisors or financial advisors or anything. So
did you guys are giving me a good hope for my down payment for my next house?
Kathy says aloha from California.
Yay.
And here's a good one. Does the VA amendatory escape clause allow buyers to get out of an appraisal gap agreement in the original contract?
So
VA.
I'm trying to remember exactly what that document says. However, I will say this in general terms outside of just VA, because I think that there's very few VA, and I think in general most contracts will allow you out of a contract in the case of a situation where the appraisal gap is too large that it can't be covered. And it's generally covered under one of two clauses, either the appraisal deadline or appraisal clause in the contract, which says that you have a right out if it doesn't appraise at the purchase price, unless you've specifically written into the contract that you're going to cover a certain appraisal gap.
And that helps you get ahead in the buyer's game.
Right, exactly. And then the other is that generally there's like a loan deadline on the contract as well. And that loan deadline basically says that if you can't qualify for the loan or you don't agree to the terms of the loan by this particular deadline, then you can also get out of the contract. So in many cases, whether it's VA or any loan for that matter, there are several opportunities to get out of the contract without jeopardizing your earnest money.
There we go. That's good. You guys, and also people sometimes, when we're doing the sight unseen experience, they were wondering if they can get out. And just if they just came up with the fact that, there were sighting issues that they hadn't even thought about, they can get out of the contract too. So, I think people sometimes are afraid that once they get in, then there's no way to get out without losing thousands of dollars. But there are ways in the contract to say, you know what, if it doesn't hit this, I can get out. If this doesn't hit this, I can get out. Yeah?
Yes, I would caution that.
Okay.
I mean, based on your video that you did with Lance, your live video with Lance, one of the things he was talking about is that sellers will probably want to accept a contract from somebody who has seen the property, versus somebody who has not. And that's exactly why. Because they don't want somebody who has not seen the property to then come 2 weeks into the process to realize, oh, I don't like the kitchen or whatever it might be, to then cancel. Because the more people that do that, the more sellers here will be less likely to sell to sight unseen buyers. So my only suggestion would be don't do that if at all possible. Okay. Right? I mean,
don't play the sellers like you just hang on to that for a moment while I think about this. Right.
I mean, put yourself in their shoes. You obviously don't want to take your property off the market in a really hot market where you're wanting to get your property sold to wait 2 weeks to realize that your property's going back on the market.
Right.
Although you will have appreciated probably in value, so maybe it's not such a bad thing. Right? So I don't know.
And I'm not too sure that I'm not seeing that many sight unseen as much as I was like in November and December anyway. Most people are making points to be here.
Well, because now they can come.
Yeah.
Before it was the 2 week quarantine mandatory, so now you can come with a negative COVID test, so a lot more people are coming.
Yeah. In fact, one of my buyers, I dropped my car off at the airport for him today, and he's like rolling around the limited inventory that is available. But people are definitely saying, you know what, I am going to still buy in this market because the mortgage interests are so good that you can't not use this money right now, right?
Well, and when we looked at buying our homes, personally, if you're planning on staying in the home long term, it doesn't really matter what the value is, really. Mm-hmm. I mean, you don't know what's going to happen with the market between now and the time that you decide to sell that home down the road, and the values could go way up, and then they could tank, and then by the time you sell, they could go back up again. So unless you're planning on being in there for a really short period of time, personally, I wouldn't worry as much about it because I think values are going to continue to increase.
Yeah, and they're not building any more housing right now. It's just it's a hot market because there are people who want to live here, and there's just not more inventory to even like expand out, right? In fact, Eric said that they said that there's a 4 million home shortfall in America right now with the amount of buyers trying to buy houses.
And lumber prices are high, and so new
trying
builds
to build
can't be
hard.
built.
I heard like a statistic of 30% more expensive. Building materials are 30% more expensive than they were a year ago.
Yeah.
So this isn't going to be something that changes overnight.
No. It's going to take months.
And I think that's one point that I want to make sure that is clear here is that rates are low, and a lot of people are worried that the housing market's going to crash because of how quickly housing prices are going up.
Yeah.
And they're comparing it to what happened in 2007 and 2008, and it's a completely different market. We've already touched on one of those things, which is appraisals, right? Appraisals may have been falsely inflated back in 2007, 2008 because appraisers were afraid of losing their job if they didn't appraise it high enough, right?
That's true.
But we were also doing 100, 103, 105% financing. We were doing stated income. We were doing no income. I mean, the whole market has changed completely from what it was in 2008. And with the supply being as low as it is, I fully anticipate that there's going to be a demand for housing for quite some time, and it's going to be a very slow move away from that. So.
Yeah.
Also, I think along the same lines that people were worried about the foreclosure market, right? People weren't able to make their payments, that we're going to have like these rolling foreclosures now, but I don't see that happening. No. And in fact, they did extend the forbearance through the end of June. Yeah. The feds did. And so you can get through forbearance through the end of June, but the repayment terms are either pay when the loan matures at the end.
Oh, they're doing that now?
Yeah. Oh. When you refinance it or when you sell it.
Okay.
So now that they're not requiring they were not requiring people to catch up on payments, then I don't see that happening.
No, people aren't going to dump their houses for that.
Right.
And also there's so much equity now in the housing that if someone was stuck, they're not going to put it into foreclosure.
Right. They don't have to short sell.
Right. They can just sell it for like a bunch of money.
Right.
Right. And so that's not, so we were talking about shadow inventory back in the day. People are waiting for the forbearance shadow inventory.
There isn't one.
It's not coming.
No.
So there you guys go. So, okay. Eric's doing the whole, look at the clock. So is there other questions that you guys might have? And as you're formulating them, I want to see, is there anybody on the call today that belongs to the 365 Ohana that has not yet won already Lance Bond and would like to let us know that you're watching, because we're going to draw for the $50 gift card for Magic's Grill if you belong to the Ohana and you haven't yet won. So mark yourself here and let me know your name, and I'm going to write it down, and I'm going to let Marla do her little pika, and she's going to pick it. So, anybody in? Somebody in.
Okay, well, that's happening.
Okay.
Josh says thanks for the answer on the question about the
VA.
There
Yep.
we go. Okay.
Okay,
and you guys do VAs.
Yes.
Yeah, they do VA loans. So, okay. Anybody? I know Lori Porter. Lori's in there. She says she's a little bit out in terms of buying a house, but because she is so enthusiastic and watches every single thing we do, you're in. What about Josh? Is it Josh Clark? Who is it? Tell me the last names. I'm actually memorizing these people now.
It's going to be a hard drawing if it's one person.
I know.
Quite a few couple have already been here. That's the problem.
Okay. And if you're not a member of the 365 Ohana group yet, all you have to do is go to movetohawaii365.com and click on Join Ohana and be part of our experience.
Josh Clark, by the way.
Oh, thank you. Josh is looking for a home right now, actually. So, well, I think Josh is part of the 365 Ohana.
And then so we have a Brian Turnbull, and he says we're in moving.
Yep.
Moving is in our 5-year plan.
Awesome.
Oh, and Josh says looking. Oh, hang on. Looking forward to getting that gift card. I won last week.
That's
but I
it.
want to
Josh
send
Clark
it-
won last week.
Okay.
I'm doing it today. I swear to God. You know.
And then, Gina, Jenna.
Is it Jeanna? And it's S.
One N.
And it's and her last name starts with an S.
Schnitzelman.
Scheitz. Okay, yeah. Okay, Gina S. Okay, so she hasn't won yet. Okay, so Josh has already won. He won last time, but I'll make sure you get that today, Josh. And then, so then it's Lori Porter, Josh, and Jeannie. That's it. Okay. Okay, here we go.
We got a Brian here too.
Okay, hold on, Brian.
Yeah.
Is he a member of the Ohana? Did he self-select?
He said we're in.
Okay, make sure you're part of the Ohana. So what's Brian's last name?
Turnbull.
Oh, but he was already in there.
Oh, okay, good.
No, I have Josh. No, Brian
it's
Turnbull.
Brian,
Yeah, yeah. And I talked to his wife is in the mix too. Okay, okay, ready?
Okay.
Okay, so here you go. Close your eyes.
Oh,
There you go.
okay.
And then what you're gonna do is you're gonna drive over it, la 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 la, and you come down on it.
Am I over the top of the names? Oh,
Okay, ready?
okay. This is
And-
like my worst childhood nightmare
That's
playing
okay.
pinata.
Well,
Okay, there you go. And that would be Jeannie.
All right.
and Brian said yes too, by the way, just in case you were wondering.
Okay, so Jeannie, you win, and I need your email address so I can get that sent over to you because I'm going to
Maybe
send
direct
you...
message it.
Yes, well,
to
get
you, yeah.
this. Yeah, direct message me because I'm going to send it to you as an online gift card because they are doing that. So I can do that for you. So next time you're on the island, come and get some Mai Tais. So with that, if there's any other further questions, we're going to wrap it up. And just know that we will be back for the mortgage update on the second Thursday of next month. And we're going to be doing our
Third Thursday at 3.
And that will be a hot topic as well, so you guys put it on your calendar. We're doing almost like so many different things on Thursdays. Next week we're going to be doing investment properties with Kyle, and he's going to be talking about if you're thinking about buying a condo or a home to use as a investment opportunity, even if you live in the home and you want to get like an Ohana unit, he's going to be talking to you guys about that. So tune in, and thanks for joining. Thank you both for joining us.
Thank
you guys
you.
always bring your
Thank you.
awesome knowledge. And if you're looking to get a mortgage and you want to reach out to these guys, Wynn and Eagan Team Citywide Home Loans,
Yeah.
and we'll drop the link in the comments for you on YouTube as well.
All right. Thanks.
Aloha!
Bye.